Ewen Cameron Watt, Global Chief Investment Strategist at BlackRock Investment Institute, joined me earlier to give us his view, or rather review, of 2014 and to talk about the divergence trends in emerging markets. Let's take a look.
Well, 2014, as long as you weren't relying on commodities to make your return, has actually been a pretty good year for global investors. Equities are broadly up, bond markets have done pretty reasonably. The weak spot, and it's got worse, of course, in the last few weeks, has been commodities. Even in emerging markets, a number have done very well. I mean, the Indian market's up all of 30%, 25-30%. The Chinese market's up strongly. The Indonesian market's up strongly. It's been a year of divergence in emerging.
I'd like us to touch on that theme, in particular kicking off with emerging markets, as you mentioned, growing in divergence. Are there perhaps renewed concerns that once developed economies start increasing interest rates, that capital will start to flow back to these stronger economies?
I think that there's a realization that emerging markets really should be improving their financial infrastructure, improving their corporate governance, improving the allocation of capital. And where that is happening, or where there is an expectation it's going to happen, India, Indonesia, state-owned enterprises in China, the stock markets and the currencies have responded pretty well. Where it isn't, and Brazil would perhaps stick out in this respect, and obviously Russia, but that's a series of other problems, then it's quite painful.
I'd like us to touch on some of those nations that you mentioned, because you mentioned Brazil, Russia. South Africa is part of the BRICS grouping of nations. It is also an emerging economy. Are there significant concerns maybe that are posed more uniquely to an economy like South Africa that might concern you?
Well, if we look at the Johannesburg Stock Exchange, if we said at the beginning of the year that coal prices are going to fall, that copper prices are going to fall, the gold price was going to flatline, we would have expected it to be a pretty poor, pretty dismal year for South African equities. As it is, the market, as of a couple of days ago, as you know, was up about 3% for the year. Now, 3% isn't very much, but it's better than -10 or -15. So I think that even within the markets, there's quite a divergent theme, and I call them diverging markets, not emerging markets now.
Maybe if you can elaborate further on that explanation, what are the key differences between the two?
Well, emerging markets was a term invented in the 1980s, and it covers now 120 countries. And by the way, the safest prediction always to make is that the best and worst markets in the world are going to be the emerging ones, because there's 120 of them. They always are. But I think that the export-led model, growing share of world trade, all this kind of stuff that's been the calling card for emerging markets as an asset class for a long time, is beginning to be overtaken by a realization that if profits don't grow, and that the economies and markets depend on capital flows rather than foreign direct investment, and that's been an important change in the last few years. If that's the case, the rules of the game are that countries that want to get capital have to show improving profits for the equity investors, that they need to develop their own domestic savings industries so there's less volatility in terms of the capital flow, and that reform and an ability to price capital correctly is an important part of the equation. And where that happens, or where there's an expectation that's going to happen, Mexico, Malaysia, India, again, Indonesia, where that happens, the currency tends to do okay, and domestic assets appreciate in price.
Interesting, you haven't mentioned any economies in Africa.
I think the condition of African markets is very tied, at least at the margin, to the outlook for commodity prices. And we can see, for example, how stressed the government bond markets in Nigeria have become. And we can see that in South Africa, as I say, there's I think a growing and interesting story which is well supported about domestic consumption, but then there's the drag from from the minerals companies, and of course there's been all of the industrial unrest which doesn't encourage a lot of inward investment.
Maybe if we move our attention now onto more developed economies, one of which has managed to surprise with regard to its latest economic data, the US. Are they moving into a positive trajectory to such an extent that maybe your investment outlook is to put more money into that market?
Well, the American economy will start next year relatively strongly, helped by the declining energy price. So, for example, an average hour's wages in America now buy 8 gallons of gasoline rather than 5, which was the case a year ago. So that helps the consumer. Equally, some of the growth in investment in shale and alternative energy will slow down because of the decline in the oil price. But yes, the American economy should be in reasonably good shape and strong shape for at least the first half of 2015. Wages are beginning to rise, temporary employment demand is rising. That's all the sort of things you would expect. Whether the stock market does as well is of course open to question, because for the last several years the economy's been sluggish, but the stock market's been strong. And that's because the single most important factor in financial markets has been monetary policy. And in 2015 the Fed will start, albeit slowly, to raise rates.
You're also quite keen on Japanese as well as European equities, and you've highlighted the fact that they are quite cheap at these current levels. If you can elaborate further on that.
Well, when you look at Japanese equities and you look at Japanese company profits, the first thing you have to remind yourself is that the way they run their accounting systems underreports profits quite significantly. And if you put them on the same accounting basis as American businesses or European businesses, they'd look considerably more profitable. But the story in Japan is it's not about the economy, and this is often the mistake that people make in saying it's all about an economy. It's about the supply and demand of securities. And in Japan, for the first time in nearly 30 years, there's a domestic buyer emerging for equities. And in fact, there's two domestic buyers. One are the domestic pension funds, where policy has changed to encourage investment in equities, and the other are the companies themselves who are buying back their shares and increasing their dividends at record levels. And that means there's a scarcity of equity in Japan relative to demand, and that's why prices rise.
Just to close off with, Ewen, there's a recent report in The Economist where it states that BlackRock has become one of the world's biggest investors, and if potentially dominance has become a problem. Your response to this, is it difficult to be more nimble and more agile the bigger that the organization becomes?
Well, we're investing money for our clients all over the world in many different ways. We do think a lot about financial market liquidity as a general point, and we're anxious and keen to encourage reforms that help that stock market liquidity. And we are, as a matter of record, the biggest asset manager in the world. But that means we pay a lot of care and attention to every single client and every single client's needs. And I don't think we've found it too much of a problem yet, but it's something that, when we look at individual investments, we need to think about liquidity risk when we invest on behalf of our clients.